So you're thinking about investing in mutual funds, but it just feels overwhelming, right? You're hit with all this jargon and this nagging feeling of uncertainty. But what if we could clear all that up? Stick with me, and we're going to demystify mutual funds in just the next few minutes.
And this is probably the #1 fear holding people back, isn't it? You put your hard-earned money into a fund, and what happens if the company itself goes bust?
And then bam, you hit with this wall of jargon. Active or passive? Growth? Dividend? What does it all even mean? It's enough to make your head spin and just make you want to give up before you even start.
And on top of all that, there's a how. Do you invest a little bit every month in SIP, or do you go all in with a lump sum? Don't worry, we are going to tackle every single one of these questions. By the end of this, you'll have a clear roadmap.
All right, let's dive right in. First things first, what even is a mutual fund? Let's break it down to its absolute basics.
The clue is right there in the name. It's mutual, because a whole bunch of people, just like you, are mutually pooling their money. They're teaming up. And that creates one big fund that can then be invested. Simple as that.
Here's a great way to think about it. Imagine you need to fly from Delhi to Mumbai. Now, you've got two choices. Option 1, you could charter your own private jet. I mean, how cool would that be? But it's going to cost a fortune. That's kind of like hiring your very own personal fund manager. Or option 2, you could just buy a regular airline ticket. You're sharing the plane and the cost with hundreds of other people, which makes it super affordable. Well, a mutual fund, that's your airline ticket to the world of professional investing.
Okay, so let's get back to that big, scary question we talked about at the start. What happens if the company you invested with, the asset management company or AMC, what if it goes bankrupt? Is all your money just gone? Well, no, and here's why. The whole system is actually set up with this really smart 3-tier safety net. So you've got the AMC, right? The brand you know. They only manage the money. They're the ones making the buy and sell decisions. But, and this is the crucial part, the money itself is legally owned by a completely separate entity, a SEBI-registered trust. Its whole job is to protect you, the investor. And then the actual shares and bonds, they're held by another separate company called a custodian.
So what does all that mean for you? It means your money isn't just sitting in the AMC's bank account. It's invested in real things, shares of companies like HUL or Colgate. So even if the AMC were to go bankrupt, the trust and the custodian make sure your investments are totally safe. A new manager would just be brought in to take over. The value of your investment is tied to those real assets, not the fund company's brand. Okay, so now that you know your money is structurally safe, let's talk about your first big choice. How do you actually want your money to be managed? And that brings us to the classic debate, active versus passive fund. Let's use another analogy. Think of an active fund as a car with a professional driver. You're paying a skilled fund manager to navigate the twists and turns of the market, trying to pick the winning stocks and beat everyone else in the race. Now, a passive fund or an index fund, that's more like a driverless car. It's programmed to follow a very specific route. Say, a market index like the Nifty 50. It's not going to try any fancy overtakes. It just follows the road and aims to give you the exact same performance as the market it's tracking.
So when you choose a passive index fund, you're making a very specific trade-off, and it's important to understand this. The great news is you are guaranteed not to do worse than the market. You'll get exactly what the index gets. But the flip side is you'll also never do better than the market. It's a really simple, super low-cost way to just get the market's average return. No drama, no surprises.
All right, so you've picked a fund. Let's say you've decided on the Nifty 50 index fund. You think you're done, right? But wait, when you actually go to invest, you'll see a couple more choices attached to that fund name. Let's quickly decode what those mean.
Okay, you're basically looking at two main decisions here. First up, growth or dividend. If you pick a growth plan, any dividends the companies pay out get automatically put back into the fund to buy more units. It just keeps compounding. A dividend plan, as the name suggests, pays that cash out directly to your bank account. Then, the second choice, direct or regular. A direct plan is where you buy straight from the fund company's website. You cut out the middleman, which means lower fees and, over time, higher returns. A regular plan is when you go through an agent or a distributor. They help you out and they earn a commission for that service.
So let's put it all together. For most of us who are investing online for the long haul, the combination of a direct plan with a growth option is almost always the most powerful and efficient way to go. You're maximizing that compounding effect and you're keeping your costs as low as possible. So, we've covered the what and the how. We're almost there.
Now let's talk about the 2 habits that truly separate successful investors from everyone else. It's not complicated stuff either. It really just comes down to these 2 simple, powerful ideas.
Okay, habit number 1, invest systematically. Seriously, forget about trying to time the market. Buy low, sell high. Sounds great, but almost nobody can do it consistently. It's a losing game. The smart move? Automate it. Set up a systematic investment plan, or an SIP, where you invest a fixed amount of money every single month, no matter what.
And this is where the magic of SIPs really kicks in. It's called dollar cost averaging. When the market is flying high and prices are expensive, your fixed monthly amount buys you fewer units of the fund. But when the market takes a dip and everything's on sale, that same fixed amount automatically buys you more units. See how that works? Over time, this smooths out your average purchase price and can really juice your long-term returns.
All right, habit number 2, and this one might surprise you. Don't over-diversify. I know, it sounds counterintuitive. A lot of beginners think, hey, the more funds I buy, the safer I am. But what often happens is you end up buying dozens of funds that all own the exact same big stocks. You're just overlapping. This diversification, as they call it, can really dilute your returns.
I'm not kidding. I once saw the portfolio of an investor who owned 103 different mutual funds. 103. Can you imagine? They had basically just bought the entire market, but they were paying the higher fees of an actively managed fund on every single one of them. It was wild.
So here's the crucial takeaway, the simple rule to remember. For almost everyone, a well-chosen portfolio of just 2 to 4 mutual funds is plenty. That's more than enough to get you all the diversification you need without watering down your potential for great returns. Seriously, keep it simple.
And there you have it. We've tackled the fears, we've simplified the choices, and we've laid out the 2 essential habits for success. You literally have the map right in front of you now. You know what to do. So the only real question left is, what's your first step gonna be?